In this session, let's look at the different hedging strategies using the futures contract. The first thing which is worth knowing is the futures market is having a large number of participants who act as hedgers or who perform the role as hedgers because their prime intention is to reduce the risk. They are getting into the futures market with an intention to reduce some kind of a risk. In some cases, it could be a risk with respect to the fluctuations of a commodity price, right? They want to protect themselves against the fluctuations in the price of the commodity, or they want to protect themselves against the fluctuations in interest rate changes, or even a fluctuation in a stock price change, right? Or probably the companies which are dealing in export market, the fluctuations in the exchange rates. So the companies typically want to protect themselves against the volatilities or fluctuations that are arising in any of these markets, and that is where they typically choose the futures market as the platform. So to protect themselves against those kind of risks, we are talking of entering into the futures market. So here the one important term that we need to understand is perfect hedge. So whenever I use the word perfect hedge, it means that we are trying to use the futures market. We are trying to hedge in the futures market. We are trying to use the futures market, which will completely eliminate the risk. Whatever is the uncertainty, if at all I am able to eliminate the risk completely, then I call that I am getting into a perfect hedge. But in reality, that is not that easily possible. So we are talking about how do I create a hedge in such a way that my risk is almost reduced, if not completely eliminated. To in what way I can create my hedging strategy so that the overall risk can be completely reduced. So that is what we are going to look at as a part of this particular session. So to start with, whenever we are talking about hedging, it's as good as I'm taking a position in a futures market. Now there are only two positions that I can take in on a one single future contract. Either it could be a long position or it is a short position. So when I'm taking a long position in the futures market, from a hedging perspective, I call it as a long hedge. When I'm taking a short position in the futures market, yeah, I'm talking about as a short hedge. Now, the intention in as a part of hedging strategy is I am protecting myself against the loss that I can get, protect against the loss that I can get in the underlying market. Probably I already have bought some shares. Now the risk for me is the price of the shares can go down. And if at all the price of the shares are going down, then obviously there is a loss that is going to build up for me. Now I want to protect myself against the loss. So because of that, I take some kind of a position in the futures market, either the long position or the short position. So that position should give the opportunity to me in such a way that if I am losing on my shares, I will gain equally in the futures. I will gain comparatively in the future so that my overall loss combined loss is typically getting reduced. So that is where the volatility or the risk is coming down. So basically, whatever the loss that we are typically getting in the typical business operations, right? Whatever is the loss that we are trying to get in the typical business operation is compensated by the gain that comes in the futures transaction, and overall loss is reduced to a drastic extent. That is what is the main purpose of getting into a hedging strategy. So under that, if I start looking at differentiating between a short hedge as well as a long hedge, as I already mentioned, I will take a short position in the futures contract in case of short hedge. I'll take a long position in the futures contract in case of a long hedge. Now, the major scenario where a person gets into a short hedging kind of a situation is he already owns an asset, owns the underlying asset, and he wants to sell it in future, or he gets worried that the price of that particular asset or the value of that particular asset will fall in future. He wants to sell it in future, but he is still afraid that the price of it is going to fall in future. And that is where he tries to get into a short position in the futures contract, where he will fix the price at which he is going to sell that asset in future. The price is fixed today itself. So even if the market price actually goes down in future, he is still able to sell that asset at the pre-contracted price itself. And that's one of the prime reasons he can very well gain out of this, or his loss is mitigated, because if the price of that particular asset is going to go down in future, he is forced to sell it at that lessened price. But with the short position in the futures, whatever is the loss that is coming up because of the price down is coming as a gain in the futures market, because he is able to sell it still at X, whereas the market price has become X minus 15. So he is able to gain 15 per contract in the futures contract, and that is what is going to compensate him in a much better manner. So one situation where generally people get into a short hedge is when they own the asset, they want to sell it in future, and they feel that the price of that particular asset is going to fall in future. Even if it is not owned at this moment, not owned now, but whenever I am of the feeling that I may buy it, I may own it in due course of time in future, and I may still sell it. I may own it and sell it. Whenever I am of that kind of an opinion, then also I can enter into the futures market quite comfortably into the short position. So that is one more dimension where a short hedging can come into picture. So whatever is the loss that is coming up, whatever is the loss that comes in the underlying asset, is compensated by the gain that comes in the futures market. Typically, when the price of that underlying goes down, price of the asset goes down, the short futures position gains by the difference, and the underlying asset will go down. So the difference is a reduced loss. So that is what comes as a part of the short hedging position. But when I am looking at a long hedge, which is I take a long position in the futures contract, and the prime scenario in which this happens is the company is looking at buying a particular asset in future. It wants to buy a particular asset in future. Generally, let's say the raw materials that it uses for producing a product. So when it wants to buy that kind of a raw material in future, and it is worried that the price of that in future can go up, it can't buy today. See now, let's say a company X is using maize as a raw material, or probably let's say company X is using silver as a raw material to produce some product. Now, it does not want to purchase that raw material immediately because it wants to use silver somewhere at a later date and produce the product. So, but it is, let's say it is apprehensive that the price of silver will go up in future. So it wants to protect itself against that possibility of growing prices. So one way is buy it immediately, buy now kind of a strategy. But when it is buying now, one, there is a cash flow that it is blocking, right? Because it does not want it immediately. Two, there is a storage cost. There is an interest because it might so happen that it is purchased with borrowed funds. The interest is getting applied right from now itself. So there are so many other costs that are coming up when I am trying to buy it now. So the better way is I get into a forward contract, a futures contract, entering into a long position so that I can buy it in the month which I really require. So either I can do this kind of a strategy wherein I'm ready to face the additional costs, or I could have got into a long futures position. Now, sometimes it might be worthy to get into this kind of a position, especially if I have an advantage of using it whenever I require. So that is what we call as convenience yield. Rather than holding a simple long futures position, which is not owning of the asset, I can still own the asset and incur the storage costs on it because I may have some other convenience of using it whenever I typically want to start my operation. So in some cases, having it in a physical form is much better than getting into a futures contract. In that case, I will not evaluate the futures contract, but wherever I don't want the material right away and I am still want to protect myself against the rising prices, I can get into a long futures kind of a position, into a long hedging strategy. So that is one way people try to get into a long futures. And another dimension is if at all they already have some kind of a short position. If at all they already have a short position in an underlying, let's say in the stock market or in any other kind of a market, if at all they have already a short position that is existing, then to protect themselves, which means selling without owning. If at all they have such kind of a position already existing, then to protect themselves against the falling prices, to protect themselves against the rising value, they would like to enter into a long position in the futures contract. And in all these things, whether you are entering into a long position or in a short position, all these things will work more and more comfortably if the futures position is closed before the delivery. But if at all we are going for delivery, we already know that the deliveries are generally costly, they are inconvenient to operate, So all these will work quite comfortably if at all the futures positions are closed before the delivery date itself. And even in some of these a little bit more that we can bring out is the marking to market, which is mostly to do with the daily settlement process. It will adjust the futures prices slightly on a day-to-day basis. The margin requirements will talk about the performance of the hedging changing on a day-to-day basis. Even those things need to be considered as a part of coming out with a much better hedging strategy. Now, the other important point that generally comes in all these situations is hedging really required? Is hedging really required? If so, what are the benefits or what are the negatives of the hedging part? Now, generally, we have been discussing this also. To a large extent, the companies which are, let's say, into various businesses like manufacturing or retail, any such kind of businesses which are into non-financial kind of businesses, they don't have control or they don't have that kind of expertise in finance related variables. Like they don't have too much of expertise with respect to predictions of interest rates, or they don't have control on the interest rates or probably exchange rates. So what we generally see is, or even the commodity prices, they may or may not have any kind of control on those. So what we are typically saying is those kind of companies which don't have too much of expertise in any of these finance related variables, they can very comfortably protect themselves against this fluctuating prices, and they can hedge themselves quite comfortably, and this will give them a betterment in terms of taking the risks which are more core to their business. See, at least those kind of risks which are core to their business, the business related risk, the operation related risk, they, because they have the expertise in that business, they know how to deal with the situations in case that kind of a risk occurs. So they can very well take calculated risks, especially in those business related variables, but definitely not in those variables where they don't have control. Means at least for these kind of the risks, it's better that they get into the hedging process. But any hedging, as we know that it is reducing the risk, but at the same time it is reducing the scope to make upside profits, scope to take advantage, and scope to make profits is also coming down, because as the risk comes down, the return also will come down, the expected return also will come down. So the scope to make profits also will typically come down. So, but overall, it has to be looked at that the main intention of hedging is not to make profits, but to reduce the downside, reduce the chances of making losses. Because in some cases, there are quite a few arguments that go against hedging. One, it says, why should a company do the hedge? Why should the company get into the hedging process? Can't the shareholders do it themselves? Can't the shareholders get into the hedging process? Now, yes, they can very well get in. They also have similar kinds of they also have information about the company as the management. But believe me, the shareholder, the kind of information that shareholders have is always less than what the management of that company is having. So the management of a company is in a much better position to take actions quite comfortably compared to the shareholders. So it can get into the hedging more comfortably than the typical shareholder. And we also need to understand the fact that if at all the shareholders are getting into all these buy sell operations for their hedging purposes, there is a heavy transaction costs and even brokerage commissions etc. involved in the process, which will be quite higher. The economies of scale will come out if the transactions are pretty large, but if the transactions are small, all these costs become very much significant. So it becomes sometimes for the individual to perform these kind of operations, it becomes almost impractical. So it looks as if it's better that the company itself gets into the hedging process quite comfortably. But one thing which a shareholder can do is he can make his portfolio well diversified. So he can buy the shares of the raw material supplier, as well as he can buy the shares of the finished product seller. So by doing so, the overall risk can very well be diversified. Overall risk can very well be reduced. So if at all the focus is of all these well diversified shareholders, then probably hedging might look a little bit unnecessary. But as long as the shareholder is not fully diversified, then probably instead of the individual shareholder trying to do the hedging, a company doing the hedging will always be getting into a lesser transaction cost and resulting in a better benefit compared to individual shareholders doing this at their own levels. Then, the second important argument that comes out against hedging is with respect to competition. Now, in some businesses, it can so happen that if the raw material prices are fluctuating, the company can very well alter the finished goods price. Probably, if the gold prices are fluctuating, then gold jewelry price also can be increased or decreased accordingly. So there is no point in terms of hedging fixing the price of gold in those kind of businesses where there is a flexibility to change the selling price of the final good based on the change in the price of raw materials. In those kind of industries, probably by doing a hedging, the company is losing out on its potential to make extraordinary profit, but at the same time it can incur bigger losses also by getting into a hedging process, because when the price is increased, when the raw materials prices are increasing, when the costs are growing, even it can increase the selling price also. Some industries, where all the competitors are following that kind of a strategy, there is no point to remain odd one out and get into a hedging process, because that is an additional cost without giving much of a benefit. So probably hedging may not be effective in all the cases. So here there should be a big picture that needs to be looked at, an evaluation of the competitors that need to be looked at. Can we really change the sales price if the cost of raw materials are changing? If that is the case, then probably getting into a hedging strategy may not be yielding any good benefit. And we all need to understand that hedging, as long as the underlying value is falling, the hedge will create a gain, And in that situation, probably there is a lot of appreciation from across, especially if the underlying value, if the business value is down, and the corresponding hedge strategy has created a gain, then probably no issues. But if the if in against to if in against to that kind of a belief, if the business value has gone up, right? Probably it's like this: I have purchased the share, the company has purchased the shares, and it is expecting that the price of the shares will go down in future, and because of that, it has got into a short futures strategy on the share. Now, if the price of the share really goes down, the underlying, if the price of the share really goes down, the futures position will actually create a gain. So overall loss is limited. This is not a big problem at all. It will be very much appreciated. But because of some reason, let's say if the price of the share has taken an upward side but not downward, where a gain is getting created on the share, the futures will create a loss, and overall the loss is again limited, or probably here the gain is limited. And now this will raise a question mark from the senior management. Why did you get into this futures strategy which is giving me a loss? So as long as the futures is creating a gain with an underlying getting into a loss, the appreciation levels are much better. Otherwise, they may result into such kind of heated argument between the management and the treasurers that the treasurer or the finance person may find it extremely difficult to explain the scenario that the hedging is done primarily to mitigate the loss but not to make a gain. In case this had fallen, we would have protected ourselves. If it has risen, fine, we could not exploit the gain. So that is what is the negative aspect of getting into the futures contract. The exploiting of the gains will go down in case the markets are favorable. In case the markets are unfavorable, yes, you are able to reduce your loss drastically, but we are not able to take the advantage of the favorable markets. That is what will go as one of the major arguments against the hedging mechanism. So to make sure that the organization understands this kind of a situation, it should be made sure that all the senior management, they are clearly made to understand what is the real purpose of hedging, in what cases the hedging may come more and more handy, and probably the involvement of the board of directors here is very much important, because let them set the hedging strategy, let them communicate the hedging strategy across all the layers in the organization. That is when risk management comes out as a powerful tool in terms of creating value for the company. All right. See, all these hedging concepts would be more and more appropriate, or look more and more easier if I'm able to identify the appropriate futures contract, right? If I'm able to identify an appropriate futures contract which can really do the hedging, I know when the asset would be bought or sold in future. When I am very much clear about all these things, probably the hedging looks appears quite easy. But in most of the scenarios, what we find is I may not be able to find a suitable asset, a suitable futures contract to hedge my business risk. I may not be able to find a suitable futures contract which can perfectly hedge my business risk, or it is not that easy to understand the exact date on which the asset can be bought or sold in future. And we have already discussed that majority of the futures contracts will get closed before the delivery itself. How much before the delivery date the closure of the futures contract is happening? Because of all these things, the typical hedging process becomes more and more cumbersome. And all these problems are typically giving rise to another concept, which is what we are calling as a basis risk. Now, to understand this concept of basis risk, first I am looking at the definition of the word basis, which is nothing but the spot price of the asset which I am hedging, spot price of the asset to be hedged, and I subtract the futures price of the contract of that underlying asset, futures price of the contract that I am using for the hedging purpose. Now, from understanding perspective, this asset could be different, this asset could be different. So probably it could be my own portfolio, my own investments, where I might have invested in 10 different securities, some publicly traded, some privately traded, some bonds. That's my set of investments. So this is my investment, that is the asset. Whereas I'm trying to hedge it, let's say with index futures contract. So index futures is more based on, let's say if I'm going with Nifty futures, it's based on the performance of 50 stocks that are defined on NSE. But here I have only 10 stocks and probably few bonds, etc. Now this asset is different, this asset is different. Now what we are simply saying is, when I am defining the basis, I am taking the spot price of the asset which I wanted to hedge, and I am taking the futures price of the contract which I am using for the hedging purpose. Now, if these two are the same, based on the concept which we have discussed earlier, the futures price will approach the spot price at the maturity of the contract. Now, going with that kind of an assumption, if at all both the assets had been same, it would have worked out that the basis would have become zero on the expiration date, because on that day the spot price and the futures price will be the same. But on the other days, probably until the maturity date, I could expect that the basis would be either positive or negative. And even as the time changes, the basis could change from positive to negative or negative to positive, because both of them are traded in different markets. They are traded separately. So the increase in one may be may not result in a similar increase in the other. In one of them the increase may be 3%, whereas in the other one it could be 2.8% itself. So the change in basis will not be constant. The basis will keep changing at regular intervals on a daily basis. So in some cases the basis may increase, and when the basis is nothing but the spot price of the asset that I am going to hedge minus the futures price that of the contract that I am using for the hedging purpose. So if the basis is increasing, then we say that there is a strengthening of the basis, and if the basis is decreasing, then I am saying that the basis is weakening. Let me take a simple example to start with. Let's say I have taken currently, let's say today the spot price is 30 and the futures price for, let's say, 1 month later delivery, the futures price is going to be 32. Then at this moment the basis appears to be -2. Now let me assume that tomorrow the spot price has become 30.25, whereas the futures price for the same has become 32.1. Now the basis has actually become -1.85, right? The basis has increased. Spot price minus the futures price, now it is only -1.85, so the basis has actually increased, and that is where we call there is a strengthening of the basis. Now let's say the next day the spot price has become 30.5, whereas the futures price has become 32.5. Now again the basis has become -2, which means from -1.85 it has gone down to -2. That is where I call as the weakening of the basis. So that is how I look at the basis on a regular basis. I look at how is the basis changing. Now look at this. The change in the basis on a regular basis, if I am looking at whatever is the uncertainty that is coming up with the basis, is what we typically call as the basis risk. And in some cases, the basis risk can improve the position of the hedger or it can worsen the position of the hedger. Let's look at a simple scenario. If I take a short hedging position, what is a short hedging position as per our understanding? The person is already having the asset, so he is having a long position in the asset market and he is having a short position in the futures market. That is a short hedging position. So let's say the basis has strengthened, means from here the basis has gone up to here. Now what happens to this hedger? The hedger has actually taken a short position in the a short position in the futures market. Now what is happening to his overall position? It's like he has gone long on the asset. So let's say he has bought the asset at 30 and he is going to sell at 32. Now look at that, it has gone to 30.25, means he has gained 20.25. He has gained 0.25 in the spot, whereas this has gone up only by 0.1, means in the futures market he has lost by 0.1, because a short position, an increase in the price is a loss and a decrease in the price is a gain. Whereas in the long position, an increase in the price is a gain and a decrease in the price is a loss. So if I am going with that kind of a scenario, there is a loss of 0.1 here, there is a gain of 0.25 in the spot, overall resulting in a 0.15 gain. So it will improve if at all the basis has strengthened. Now we can look at these kind of situation. In a short hedge, if the basis is increasing or strengthening, if the base is strengthening, the hedger's position is becoming better. Whereas if the basis is weakening, the hedger's position is going much bad. The same example you could use. And if at all he has gone onto a long hedge instead of short, which means he has a short position in the asset, so earlier the example 30 and 32, 30.25 and 31 point or 32.1. So here the basis was -2, here the basis was -1.85. This is what is an increasing in the basis or strengthening of the basis. Now what we are saying is the person who is having a long hedge position means he is short on the asset and he is long on the futures. Okay, short on the asset, so there is a loss of 0.25 here. Long on the futures, because the price in the futures has gone up, there is a gain of 0.1. So overall there is a loss of 0.15, means the position of the hedger is actually weakening in case the basis is strengthening, and in case the basis is weakening, the hedger's position is improving. So even if the hedge, the asset which is getting hedged and the futures contract that is used for hedging, if even if both of them are same, there is a possibility of the basis risk, especially because the spot price and the futures price do not change in the same manner. In some cases the spot may grow more than the futures, or in some other cases the futures may grow more than the spot, and because of that particular reason we see that the basis keeps changing on a regular basis, and that is what gives rise to basis risk. And this basis risk could improve the position of the hedger, or it even worsens the position of the hedger, as we have seen in this particular example. But apart from that, even the choice, apart from just the change in the spot price and the futures price, the choice of the asset, because in majority of the times it is not that easy to find a perfect hedge. So it's always that how do I construct this hedge in such a way that the overall risk goes down. So from various future contracts that are available, the choice of an appropriate futures contract whose price is very much correlated with the asset's price which we are going to hedge. So that is the one that goes as the best possible choice for the futures contract. And so that's how the asset that we are using, the contract, the future contract, which assets based future contract needs to be chosen is typically going with that kind of an assumption. And on the second side, what we also look at is what is the delivery month that needs to be chosen. So if at all I require a hedging, let's say for 3 months, my underlying risk I want to hedge for 3 months, then it's better to go for a futures contract whose expiry is 3 months. But sometimes it is suggested that it's better to go for 4 months rather than 3 months, because in the third month, which is the delivery month, there could be a lot of fluctuation in the futures price, and especially for a long position there is even a risk of taking a delivery. So it's always better that we go for the futures contract which is very much closer to the time period of the hedge, but slightly more than that, which is the immediate next delivery month, is what is the choice typically in case of the futures contract. Because even if I am going for, let's say, 6 months or 12 months, probably the basis risk is going to be much higher. So too much long is also going to create an additional risk, so generally not preferred. So the obvious choice comes out with the typical delivery month, which is slightly more than, which is the closest possible to the period of hedge, but slightly more than that. So that is the kind of delivery month that needs to be chosen. And of course, the one more important point that needs to be kept in mind is, see that whatever the futures contracts that we are getting in, there is sufficient liquidity for that. Means there is enough of buying and selling that is happening, so that even at any point in time we want to close the contract, it should not become difficult, because I mean, there should be a mechanism where the counterparties can be identified easily, which means the frequency, the volume of the transaction should be significantly effective. And that's one of the prime reasons what we see is the short term future contracts have more and more liquidity. So people generally try to get into short term hedging positions, even though their the delivery, even though the asset that they want to hedge, the hedging period, even though it is let's say 12 months, they try to get into a 3 months futures contract and roll it over. After 3 months, they get into another 3 months, another three, another three. This is typically called as rolling the hedge kind of a strategy, which we'll discuss slightly later. But this is also a mechanism because this ensures more and more liquidity in the futures market. So that is one more dimension to typically look at while getting into the choice of hedging strategy. So three key things that needs to be looked at while getting into a hedging strategy is what is the asset that I would be choosing in the futures contract to hedge this. What is the delivery month which I would be choosing in the futures contract, right? And what is the kind of a liquidity that is typically associated with the futures contract, and how is the basis risk coming up as a part of the futures contract. All these things are primarily looked at before choosing an appropriate strategy for the hedging purposes. All right. Now we will discuss about this particular concept called cross hedging. See, we have said in most of the cases, let's say I want to hedge my underlying portfolio, or probably I want to hedge my risk of a particular raw material X, right? Now, the ideal scenario would have been getting into the futures contract of X. But the exchange might not be dealing with the futures contract. You're dealing in futures contracts for the asset X. So, for me, the next important thing is to choose which particular futures contract reflects the price movement of X more and more in a better way. Which particular assets futures reflect or resemble the price movements of the raw material which I am planning to hedge. So if the asset that needs to be hedged, the asset to be hedged, and the futures contract, the underlying asset in the futures contract that I am using to hedge, if they are different, that procedure is what we are calling as cross hedging. So whenever we talk about cross hedging, a few important things that come into our mind is one, what is the hedge ratio? The hedge ratio, whenever I talk about, it is nothing but the size of the position in the futures contract, the size of the position in the futures contract, I divide it by the size of the exposure in the spot. So that is what I typically call as the hedge ratio. If at all the asset, this asset and this asset, the asset that I am going to hedge and the asset that I am using in the futures contract for the hedging purpose, if both of them are the same, the hedge ratio can quite comfortably be equal to 1. But in majority of the cases, these two could be different, which means the hedge ratio of 1 may not be optimal at all. May not be optimal at all. And that is where we talk about determining the hedge ratio which will be more and more optimal. And when I am saying optimal, it tries to minimize the basis risk or minimize the variance of the value of the hedge position. Variance of the value of the overall combined position is what we are trying to determine as the hedge ratio. And as a simpler formula part of it, the hedge ratio, typically the optimal hedge ratio, comes out as finding out the correlation between the change in the spot price and the change in the spot price and the change in the futures price. Take the correlation between that and multiply this with the standard deviation of the spot price change and divide it by the standard deviation of the futures price changes. This is what will give me the typical optimal hedge ratio, which means if at all I have this correlation as 1, which generally comes out if the asset is going to be the same. So this correlation is coming out to be 1, and if the standard deviation for both of them are the same, then in that case the hedge ratio is going to be 1, otherwise the hedge ratio can quite comfortably be different. So it's as good as saying, probably if I am trying to plot the delta S, whatever is the change in the spot, and the change in the futures, if at all whatever if I'm looking at the best fitting line between the two, the slope of this best fitting line is what we are calling as the hedge ratio. So this is typically coming out as the optimal hedge ratio in this situation. I take the correlation between the change in the spot price and the change in the futures price over the period, multiply it with the standard deviation of the spot and divide it by the standard deviation of the futures. That is what is going to give me the optimal hedge ratio. And one more important point that I need to look at here is another term called the hedge effectiveness. The effectiveness of the hedge is nothing but the R squared that is coming out of this particular transaction. So we have already defined the hedge ratio as something like this. So from here the R, which is the correlation, comes out as hedge ratio times standard deviation of the change in the futures price divided by the standard deviation of the change in the spot. Now when I want R squared, which talks about the effectiveness, because we are talking about this particular mechanism as delta F, delta S is the x-axis and delta F being the y, and a regression is performed with delta S being the independent variable and delta F being the dependent variable. So the slope of it is what we called as hedge ratio, and that is where if at all I have to talk about the effectiveness as per the regression understanding, the R squared will talk about the effectiveness of the hedge. So here I'll take it as hedge ratio squared multiplied by the standard deviation of the future price changes square, variance of the future price changes divided by the variance of the spot price changes. So that is what is coming out as the hedge effectiveness. So the higher the value, the higher we talk about the effectiveness of the hedge. Otherwise it will show in kinds of percentage terms. The value for that at the max can be equal to 100% only. So the more it is closer to 100%, the more the hedge is effective, the more it is away from it, the weaker is the effectiveness of that particular hedge. And from there, if at all I am looking at finding out the optimal number of contracts, right? Optimal number of contracts to get into a hedging position. We are talking about go with an optimal, the hedge ratio, whatever we called as an optimal hedge ratio. Take what is the size, multiply it with the size of the spot market, which is the size of the asset that you want to hedge, and divide it by the size of one futures contract. Size of so probably it's as good as saying take the hedge ratio, multiply it with the size of the asset that you want to hedge, which is the exposure to risk, and I divide it by the size of one futures contract, and this is what is going to give me the optimal number of contracts that I have to get in to remove my risk, to hedge my risk to a large extent, to reduce my risk to the best possible extent. And here, once we have got into that kind of a futures contract, so if my underlying position was a long position, I'll take those many short positions in the futures contract. If my underlying position was a short position, I'll go long on the futures contract to that number of contracts. But here, because of the mark to market settlement mechanism, the future price changes on a daily basis. The settlement happens on a daily basis. So because of that, the futures price changes on a daily basis, the spot price changes on a daily basis, the optimal hedge ratio changes on a daily basis. So if at all I have to be more and more dynamic in terms of either going for more future contracts or reducing the number of future contracts depending on the changes in the spot price and the future price because of the daily settlements that are coming up, we call that kind of a process as the tailing the hedge process. So I'm following the hedge on a regular basis, and based on that I'm trying to find out the optimal number of contracts on a daily basis, which is what I'm using for the purpose of either increasing my position or decreasing my position in the futures market. So to do that, to find out the optimal number of contracts, the simple logic is you take the hedge ratio, which was already the optimal hedge ratio, multiply it with the spot price and divide it by the futures price of that particular day. Multiply it with the spot price and divide it by the futures price of that particular day, which will give me the updated number of contracts or updated hedge ratio. So updated hedge ratio, if I am trying to take the modified hedge ratio, based on that I can try to see the number of contracts which I can either increase or decrease. Decrease is I will offset the positions then and there. Increase means I will enter into a fresh positions in the futures contract. This is what typically happens as a part of the tailing the hedge mechanism. Alright. So the same concept, if I use the hedging ratio concept wherein I talked about the optimal hedge ratio is the correlation between the change in the spot price and the change in the futures price multiplied by the standard deviation of the spot price change divided by the standard deviation of the futures price change. If at all this particular concept I am taking into the context of the stock index futures. So if I am using the stock index futures instead of the asset which I am using for the futures contract, let's say is the index futures, then what is happening is this entire thing, the correlation between the change in the asset price and the change in the index multiplied by the standard deviation of the change in the asset price divided by the change standard deviation of the change in the index is nothing but the beta. Right, we can recollect the concept, the correlation multiplied by the standard deviation of the security were divided by the standard deviation of the market or of the index is what we call as beta. So which means the optimal number of contracts to actually do a hedge, if at all I am using the stock index futures, directly comes out as beta multiplied by the size of the asset that we are going to hedge divided by the size of one futures contract. One index futures contract I divided by the size of one futures contract to arrive at the optimal hedge ratio, especially if I am using the stock index futures, because the concept, this entire logic of correlation multiplied by the standard deviation and dividing by another standard deviation, it entirely works out to the concept of beta. So now if I'm talking about hedging my portfolio using the stock index futures, now all I am talking about is I'll find the beta of the portfolio with respect to the stock index futures, take the standard deviation of this portfolio divided by the standard deviation of the index futures to identify the optimal number of contracts. But if this portfolio is more or less a mimic of the index, more or less resembles the index to a large extent, then we find that the beta is going to be 1. If that is the case, I can talk about the optimal number of contracts as the size of the portfolio that is going to be hedged divided by size of one single futures contract. Right, so that is what can give me the typical the optimal number of contracts, because the hedge ratio in that case anyhow is going to be equal to 1. So that is what will give me the number of optimal future contracts that I can typically get into. But wherever the portfolio is not the same as that of the index, then I will depend on using the beta. I can find out the beta using the regression mechanism or using the capital asset pricing model, especially when I am trying to plot the standard deviation of the security, the systematic risk of the security here and the return of the security here. The slope of this particular line is what is coming out as the beta. Or on the other side, we are talking about excess return of the portfolio, excess return of the portfolio over the risk-free rate. I'm regressing it, excess return of the market over the risk-free rate. Whatever is the best fitting line that is coming between the two, that is what we are even calling as defining as beta. The best fitting line, the slope of that best fitting line is what we are calling as beta. So the optimal number of contracts in this case comes out as beta multiplied by the size of the asset that I am going to hedge, which is the size of the portfolio that I am going to hedge. I divide it by size of one single futures contract. Generally, I use index futures to hedge a well diversified. Generally, I use this to hedge a well diversified portfolio, or even the same index futures can be used to hedge even a single stock also. But the prime intention is always but the prime intention is always look at the beta, right? Beta multiplied by the size of the security that I'm going to hedge, size of the risk that I'm going to hedge, divided by the size of the futures contract. But in that case, the beta will directly become equal to zero of the total overall position. From beta, the risk of that particular combined position is becoming zero. Rather than that, I might even think of reduce the beta. Why make it zero? Right now, if the beta is 1.5, I may want to make it zero point 0.9 or 1. If that's the case, I want the beta to be reduced from beta to, let's say, beta 1. So the number of contracts that I will typically get in will be simple. Only the only this is changing, because in the earlier case it is like the beta from whatever is the current risk, I want to make it zero. So that's where these many contracts had to be gotten, optimal number of contracts. But if I want to reduce the beta to say some beta 1, then the optimal number of contracts can be looked at from this particular dimension itself. And if at all, see, generally whenever we are getting into any of this hedging processes, it is as simple as this, especially when I'm going with the stock index futures. Anything I'm doing as a hedging, I'm going with an intention that the portfolio which I'm having, that it will perform superbly. But at the same time, I want to eliminate those kind of risks which are getting created by the market. I want to eliminate the market risk, and I want to take that particular risk which is created only by the performance of that particular portfolio itself. So anything to do with the market, the general market situation, I want to remove that kind of a risk. So the additional risk that is coming out because of the market movement, I want to remove it by getting into a hedging using the index futures, and I want to get exposed only to the performance of the portfolio relative to the market. I don't want to go with the risk that is involved in the market as a whole. So that is what is the main intention to get into a hedging using the index futures. The other kind of a motivation to get into an index future is probably the holding. I want the holding period to be long, but I want to protect myself against the short term uncertain market. So probably there could have been a mechanism where you sell it off in the short term and immediately buy back, sell and buy back kind of a mechanism. But in this case, the price could be much higher. The rate at which you may buy that portfolio back could be at a much higher rate. But rather than that, you can use the stock index future to typically reduce your size of exposure quite significantly. So all these things, whether it's a portfolio or one single individual stock, the intention is still the same. The stock or the portfolio, you are expecting that it will outperform the market, but you are not sure about the performance of the market as such. So you know that it is like this. Let's say this is the what the overall market will perform, whereas your particular stock or your particular portfolio will perform this much extra over what the market performs. So I want to eliminate the risk which is associated with the market, which means even if the market down performs to this extent, your stock is going to perform slightly more than that. But I want to eliminate the market risk altogether, and that is where I am getting into the stock index futures mechanism. So as we have to very clearly understand with respect to any of the hedging scenario, as long as the underlying is falling, the futures position will gain and overall the loss is reduced. That is an appreciable situation. But at the same time, every hedging will try to eliminate a possible gain. If the underlying is gaining, the corresponding futures will lose for you, so even the gain is getting reduced for us. So we have to very clearly understand that unfavorable outcomes generally are made less unfavorable by reducing the possibility of loss, but at the same time the favorable outcomes also are made less favorable by reducing the possibility of making an upside gain. That is one important point that we need to understand with any kind of futures transaction. While it can reduce the loss, it can even reduce the possibility of making a gain quite drastically. That's an important point that we need to understand as a part of any derivatives transaction. The intention is to reduce the downside, but in that process, even the upside is getting compromised to a great extent, right? Then one more context that I would bring in this session is rolling the hedge forward. See, in some cases, probably I want to protect myself, let's say for a 2 year period against the change in a commodity price. Now, or probably a change in the stock price. So, I have got into using the index futures to protect myself against the change in the stock price. But I have seen that the index futures at the max are available for 3 months delivery or 6 months delivery, not more than that. But I want to protect myself for 2 years period. Then what could generally happen? I will take the contract for 6 months. I'll take the contract for 6 months, close this here, and again open a fresh contract for another 6 months, close it here, and again do it until my risk is overall protected. Now this kind of a mechanism is what we call as rolling the hedge forward. But here what we could clearly see is, at this point I know what is the price at which I am entering into the contract. So I know to what extent I am able to protect my risk. But when I'm opening a fresh contract here, I don't know what would be the futures price here. Here I would know the futures price, but that would be only for 6 months period. But when I'm entering into a fresh contract after 6 months, I don't know what is going to be the futures price, which means the risk is not fully mitigated, or risk is the level of risk that gets mitigated is not known fully in advance. But that's the only strategy that is available for me. I close it and again I reopen afresh, which means I am exposed to a rollover risk here. Because of the rolling over, I don't know the price at which I would be entering into the futures contract, which could create additional layers of risk as a part of my hedging strategy. But yes, if at all the protection is needed for a longer period, this is one more option. Generally choose a short term futures contract. Even in some cases people intentionally prefer this because of the liquidity that is associated with the short term futures contract. So they try to enter into a short term contract, probably a 3 months contract instead of 6 months. At the end of 3 months, offset the position and again open a fresh position. But the price at which they are going to open up is going to be a big deciding factor, which will have an impact on the overall profitability. But understanding the strategy of rolling the hedge forward will be very much important in terms of designing a strategy for hedging your portfolio risks or hedging your underlying risks using the futures contracts more effectively. So these are some of the things which I thought I should cover as a part of this session. If you had any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.